Hello, students, and welcome back to another accounting episode. Today, we're going to talk about perpetual inventory systems. So, let's see what we have today. So, first of all, we would like to know why would a business do this? Why would any business will run a system to see how much does he have in an inventory at any time? So basically, a business would like to know how much stock he has and what is the cost of this inventory in order to later on knowing how much profit he made, or most likely what is called a gross margin. And here we say gross means total margin. It's not a net margin. It's not a net profit. It's just gross. So a gross means it does include that margin. It does include the fixed cost like rent, wages, salaries, utilities, and so on. So it's just a gross. So it's just only the cost of the selling goods and the the selling revenue itself. The revenue less the cost of the selling goods. Let's see more details down the road. So businesses do this in order to figure out how much gross profit they have done at the end of whatever period is. Could be a month, could be a quarter, could be a year. Most likely a month would be more likely to a reality. So we have two systems here. We have first in, first out. And this is going to assume that the first goods you buy is the first goods that you are going to sell. So let's take an example here. We have a business here that is starting an opening stock was 150 units. So whatever this units you want to call it, cell phone, computer, laptops, pair of shoes, t-shirts, whatever those units are. He bought them at that time. So this is a retail store. It's not a factory. A retail store buying 150 units of whatever goods you may consider at the cost of 21. So let's see how is that going to reflect in our schedule. Here it is. I have a cost of goods purchase. We have sold goods, and we have the balance here, or on hand, remaining balance, or on hand, or balance, whatever you call it. So here it is, our beginning, opening, starting, whatever you want to call it. So first day of the month, I have 150 units at the cost of 21. That gives you the rate of 31.50. So not in this column. It's not a purchase. It is not a sold transaction. It's just a balance. So where this came from, most likely came from the last month. So it came from June, if I could say, June 31st. June 30, I'm sorry, June 30th. So the balance moved to or transferred to the next balance sheet for that month. So that's as the opening stock. So let's see the next transaction we have here. Oh, we have a sale here of 120 units. The selling price is 35. So we're not going to care much about the selling price at this moment. The schedule is only about cost, and cost. There is no selling prices here. This is just to calculate the cost of the selling goods. So here it is. I have 120 units sold. So it's not in this column, it's right there. And I'm going to subtract from the goods in hand. So 120 minus less 120. So balance of 30 at the cost of 21 down to $630. 120 less 150, 150 less 120, 30 times 21, 630. The next transaction we have here, we have a purchase were brought in or purchased, received, all are the same. 225 units at the rate of 27. It's not the same price as this, so you can't add them up at this moment. I'm gonna do this here. You're gonna do 200 and you have a 225. So right down here in purchase column. So you have the previous balance of 30 and the new balance of 225. The 31 remaining from 150 and the new one 225 at the rate of $27 gives you the cost of 6075 $6,075. Next transaction, we have 180, a sale of 180 units at the rate of 40. Don't forget, table is about, the system is about calculating the cost, not the revenue. I'm going to do the revenue in a separate transaction. We're going to do it separately. So let's sell 180. We're doing FIFO. So let's sell from the first stock we had received. The first stock we had is those ones. So I have 30 and 220. So in order to sell 180, I can't sell 180 since from the old stock, since the remaining is 30. So I have to sell the 30 first. Then I take 150, the balance of 180 from this stock. So 30 at the rate of 21 down to 630 and 150. I'm going to take it from the new stock 225 after I'm done with the old one. 225 less 150 down to 75 units. So 30 units all gone. The old price, the 21, the old cost, put it that way. And 150 from the rate of 27, cost of 27, 40, 50, the remaining is 75 units at the rate of 27, 20, 25. So that will translate this transaction, the second sale of 180. Finally, I have a purchase of 210 units at the rate of 33. That's a cost, not a selling price. So a cost of $33. Let's see how is that will be recorded. 210 units at 33 gives you a total of 6930. Remaining stock from the last transaction is 75 at the rate of 27. I'm going to add the new purchase of 210 times 3, $33. Now, let's see. At this case, I need to add the last ones. All these goods are in and out. And here, the last transaction I have was here at the last one. So no more transaction. So this is what's left in hand. So adding these two figures will give you what is called a cost value. Cost value is the last transaction after all the transaction has been recorded. Then you add the last ones here. This is what I have in my warehouse. 2025, 75 units at rate 27 and 210 at the rate of $33. So that gives me a total of 89 and 55. 89.55 is what is called cost value. Basically, the value of the goods that I have remaining in my warehouse at the end of the month. $8,955. Finally, I need to get what is called a gross margin. How much margin did I did, or how much gross, if I could say gross profit, not a net profit, how much gross profit I have done based on these transactions. So let's calculate our sale. I have first sale of 150 units here. I'm sorry, the first sale is 150 units right there. I'm sorry again, it's sale of 120. Sorry about that. At the rate of 35. On the second sale, I have 180 at the rate of 40. So let's add them up here. 120 at the rate of 35. Here I'm using the selling price. Where did I get this from? Right here. 120 at the rate of 35. 180 at the rate of 40. Add them up, you get your revenue for this month. So this is a simple example. I mean, you most likely will have more than a transaction, sales transaction, but just to make it simple and easy, these two will add up to 11,400. Now I can put my revenue here to calculate gross margin. 11,400 less the cost of goods sold. It's right there. That's what I was doing here. Cost of goods sold, or cost of the sold goods. Right there. I have this amount, 120 at the rate of 21. I have, this is my transaction, the sell transaction, but at the cost wise. This is cost wise. It's not a margin. It is not selling prices. This is my cost of the goods that was sold. I exactly sold here 120 and 180. 120 at the rate of 21, right there. 180 was 30 and 150, because I didn't have enough from the old stock. I sold everything, consumed all of them. Then I moved down and I took 150. So I have a total of 180. Remaining is this. So we're not worried about this anymore. We're going to worry about this. Adding 2520, 630, 4050 gives you a total of 7,200. This is the total cost of goods sold. Cost of goods sold, or cost of the sold goods. Now, having my revenue and having my cost of goods sold gives me the gross margin. It's down to 11,400 less 7,200, down to 4,200, 4,200. This is my gross margin. The gross margin in this case includes, it does include all the fixed costs like rent, utilities, and so on, salaries, and other things. So those are including this. If I have those figures, subtract them from 4,200, I get my net profit, but we are not in this any at this moment. So all I need to know, what is my gross margin? Right there, sale revenue less cost of goods sold. Got it from here. And that would be it. Thank you for watching my video. Please don't forget to subscribe. And I'll make another part. I'm gonna do part 2 video to explain or to work with LIFO, which is loss in, first out. I'd like to thank you all for joining me, and I wish you a very pleasant and have a nice day.